How significant is this? How investable is this in terms of the German response?
Yeah, perhaps. I mean, what we've seen in the last couple of weeks and months, really, is actually that the German DAX was outperforming quite a lot over the, against all the other peers, whether that's France, whether that's, for example, against the broader Eurozone equity market. And that probably is also partly due to the very outsized response from the fiscal side in Germany that, if we look at the last 8-9 years, we really haven't got used to. So perhaps that has a little bit more room to run, yes. But overall, for Eurozone equity markets, I doubt there's going to be this very strong, rotation out of US equity markets into Eurozone equity markets. I think that's where the signal, just, an extension of a furlough program in Germany is not as invested as it seems, I think.
Okay, and is this something that only happens in Germany? Because Germany was well prepared for this in the sense that they already had this furlough scheme up and running as part of their general infrastructure. It's been employed before, hasn't it, Max? So is this something that only Germany does because it had it before, and also it has the fiscal depth to go ahead with this kind of extension?
Well, you've given the answers, right? That's exactly the point. I mean, Germany has used it after the global financial crisis quite successfully, together with the car scrappage package in 2009 and 2010. That's when you look at the numbers, when you look at the GDP numbers back then, that's what really helped Germany get out of the woods faster than Eurozone peers. And that's, the infrastructure is there. The problem also is with other countries, you've asked before, can other countries do that as well? I doubt that other countries, particularly on the peripheral side, have that kind of fiscal depth to really deploy that much of fiscal aid to extend any kind of furlough programs or other programs up until the end of 2021. I think that's quite unlikely, and that is perhaps a little bit more of a German special case.
Well, the German special case is about income substitution, and I guess, Max Kettner, it's about social policy as well. We've seen a huge deterioration in the United States just in the last 10 days here as the stimulus runs out, and as many people said, the excessive unemployment amounts have drifted away. Very simply, Max, define how economic growth, GDP, will be different given income substitution in Germany and Europe versus the process in the United States?
I think that's a very interesting question. If we go into, let's say, the third quarter data, but particularly also the 2021 data, think about, for example, the effect of the stronger euro now, right? The euro, the trade-weighted euro, has been up more than 7% since the low. That obviously will probably put a little bit of a lid on inflation in the Eurozone. It will put a little bit of a lid on growth also relative to the US. Whereas actually what we've seen, when you look, for example, at the Bloomberg consensus numbers for 2021, consensus expectations for US growth in 2021 have consistently been revised lower in the last couple of weeks, whereas the exact opposite applies for the Eurozone. So I think, for the Eurozone against US growth, not only from a substitution perspective, but particularly from a consensus perspective, it kind of seems like perhaps consensus has become a little bit too jubilant on Eurozone growth and a little bit too downbeat on the US.